So yeah, we'll start with the equity items. We'll go to the equity items here. We have share capital in this case. We'll bring our share capital. The share capital value is 18,000. Our reporting should be the same as acquisition. Then we bring our revaluation surplus here at reporting date was 0. So as reporting date, we're not having any value for that. But I could quite remember that during the year, they told us that 1,200. Do you remember the 1,200? The 1.2 million. It relates to Paradise. Paradise is a subsidiary in our case. So it relates to Paradise. So we need to account for that revaluation gain. That one was within the year and was not accounted for. So we need to account for that. So I'll bring that one there. So that was a revaluation gain of 1,200. Our reporting date to be the same figure at post acquisition. Then we have retained earnings over here. So we bring our retained earnings. So it's 7,000 here. Then we need to bring the acquisition date, retained earnings. How do we get acquisition date, retained earnings? To do that, we need to know during the year the profit they made. So during the year, they made a profit of 4,000 Ghana cedi over here. They made a profit of 4,000 Ghana cedi. But I should take note that this 4,000 Ghana cedi is without any adjustments. Was without any adjustment. So if you take the 4,000 from the 7,000, how much should have been the value for the year?
2,200 or 3,200. So,
How did you
hey,
get a 3,200? I said 4,000 from the
7,000,
7,000 or
3,000.
I would have just been 3,000. Yeah, that would have been a big mistake. So in normal case, that would have been the procedure in that case. That would have been the procedure in that case. But yeah, we did the NCI profit. We calculated for the adjusted profit. Our actual adjusted profit we had was 1,800. Bear in mind that yeah, we have already accounted for uh, the depreciation and other items like the impairments already. So someone can just go straight forward and just use the 1,800 as the post acquisition profits and account for that straightforward. Another person can just, like if you are doing for position straightforward, another person can just look at the opening date value and then do that in that respect. So yeah, the value here at the acquisition they will have been 7,000 minus the 4,000 profit. If I'm to go by the usual approach for that, to be 7,000 minus this 4,000. But remember that this 4,000 is for a whole year. So we even need to multiply this by 9 over 12. That will give us how much? I think we already calculated for this already. I think over here.
3,000.
3,000, yes. So the post acquisition profit here without adjustments, if you are doing the one without adjustments, will have been 3,000. so that the acquisition date here will be 4,000. I hope you get this. So we have two ways of going about it. Another person can just bring the 1,008, meaning that you have already accounted for everything already. If you still want to show the adjustment again, then it will be the 7,000 here minus the profits. And then the profit here will be 4,000 times 9 over 12, which gave us 3,000, which we brought here. So that the acquisition date value here will be 4,000. So this is one way of going about it. I think this will be better for everyone. Let me not do the other one. So that's retained earnings in that case. And the next thing we do is we bring our fair value. There was a fair valuation in the question. Hold on, the one who has asked the question, hold on. So there's a fair value in the question here. Let's bring the fair value. There was a fair valuation. Yeah, that was additional information too. That there was a fair value of our PPE of 8 million above the current amount. So we need to record that 8 million in that case. Then we bring the depreciation in that respect. The question gave us the depreciation too on the fair valuation to be 200,000. So yeah, we record that as 200. In that case, here we dash and then 200 here come in. So this will be the depreciation that we need to bring. Then the provision for unrealized profit, we realize that it's related to the parent, so we're not going to bring that here. I think that will be all for now. So we sum this up. We sum all of these up. So this becomes the respective figures we will get over here. And remember that when you get this 4,000, as I advise, you need to separate it between post-acquisition profit and then that of the revaluation. So the profit element here and that of the revaluation, post-acquisition revaluation. So the post-acquisition revaluation surplus will be that of the revaluation gain here, the one we had as 1,200. I'll bring that in that case. And the post-acquisition profit here will be the 4,000 minus the 1,200. What are you going to get?
2,800.
2,800. 2,800. So that will be the post-acquisition profit. Okay, I've been given several alerts. Eric, your hand is up. Go ahead.
Uh, the retained earnings, how you got the data, and can you take that part of me? Because I didn't get it. Thank you.
You calculate for your profit for the period, the subsidiary profit for the period. And we have even done that over here. Should have just picked the one here. We have done the subsidiary profit for the period, right? It was
Yes, sir.
4,000 multiplied by 9 over 12, right? We had
Yes, sir.
3,000, right?
Yes.
Yeah, so in fact, that will be our post-acquisition profits over here.
Okay, yeah.
If you know your post-acquisition profit, you can calculate for the retained earnings, right? That will be the difference.
Oh, okay. Okay. Thank you.
Okay. Well, is there any other? I think there were several hands. Yeah, please go ahead.
Yes, yes. So, you see, in the event where what we are used to is starting with the net asset subsidiary before getting to the NCI we worked for. So, in the event where what we are used to, we are doing that. How do we still arrive at the retained earnings figure at acquisition, or we will still, per this question, we will still have to calculate that one before we'll be able to get the, because I'm a little bit confused with this new format that we are doing.
I'm not doing any new format, by the
I
way.
mean, the procedure that we go through, we start with
Yeah,
the group structure, the cost of investment, and then the net assets of the
yeah. So
subsidiary.
we
But
do that.
in this case,
We do that when you are
mhm,
purely doing the position, right?
mhm,
Yeah, when you are purely doing a position. But in this question, we're having it two, and I decided to separate the the two so that we get a comprehensive understanding. So the question, your
okay.
first question, how do we get the post acquisition profit? If I get you right, that's your question, right?
The retained earnings we get, yes, at the post acquisition period.
Yes.
We
So
had to pick the 3,000 we computed at the NCI
okay, so
subsidiary share of profit. Uh-huh.
yeah, I get your point. So with most of the questions like we solved in the class, you remember that the acquisition date values will most of the time be given to you, right?
Yes,
And then you check within the question whether the retained earnings has been given to you or otherwise, the reporting dates, which will most of the times also be given
yes,
to you. But
yes,
if you quite remember in class, we even solved a question whereby we're not given acquisition dates, we had to look for it.
yes.
So if you're not being given the acquisition date value and you have to look for it, how do you get it? You first pick your retained earnings, the closing balance you have, the reporting date value, and then you less your
Mm,
profit for the period.
yes, yes.
And that's exactly what we have done. So it's the same thing we did
Mm,
when we had the class.
okay,
Yeah,
okay. Okay, but in this one, we had to apportion it because it was acquired in the middle of the year.
exactly.
Okay, okay. All right, thank you.
Yeah, Chrissy. Chrissy, your hand is up. You are muted. Okay. So let's make it away. Yeah, yeah, Chrissy, do you want to talk now?
Yes, I wanted to talk about the evaluation. So is the 2,800 being the post acquisition profit. So the 4,000 that we got earlier, is it just for like because of formalities?
It's a combination of both profit and then revaluation. So when you go to NCI, we take the total. But NCI will take both the profit and revaluation before we share.
Oh, okay, okay.
Yeah, Esther, your hand was up.
Please, I want to confirm the acquisition date retain earnings. You mentioned after you take the reporting date and then you subtract the profit for the year. I was thinking, I don't know if that's what I heard. I was thinking the acquisition date is shouldn't down be the where the question is actually the profit for the previous year, the year.
Yeah, so your post acquisition profit, you less that one to get the acquisition dates. So your reporting date, then
Okay.
you less the
Uh, mm,
remember your reporting date to be at year end, right? Then you less
yes, please.
the profit after acquisition. Yeah.
If we less the profit after acquisition, would you rather be getting 3,000 or
What's the profit after acquisition?
the 4,000
No, 4,000 is for the year.
after acquisition?
You have to multiply by 9/12 to get the post acquisition profit.
Yes. Okay.
Remember what we did here earlier? It's the same thing. I don't know why. The same thing. The subsidiary profit for the period. We did 4,000 times 9/12. We had 3,000. So this is the profit for the period for the subsidiary. Now to get the acquisition date value, we needed to subtract the 7,000 minus the 3,000 to get a 4,000.
To say even if we weren't calculating for statement of P&L separately, we still do the
Oh yeah, yeah,
post
yeah.
acquisition
In class
profit
we
and
even did
subtract it
yes,
from.
sir. In class, remember we did some like that.
Say I'm not
Because
sure I joined that class. Say
okay, maybe I forgot it.
thank you.
You're welcome. So let's move on to our next weekend's goodwill. So for goodwill, the first thing we need is our purchase consideration. So purchase consideration, yeah. We'll check the purchase consideration we have in the question. That was from additional information. You can clearly see that we had a share exchange here. So we will account for share exchange in this case. And then we have the deferred one we did. So let's do the share exchange. The deferred we have already calculated for that. We'll just bring the figure in that regard. So the share exchange here, we'll bring we'll look at what the question demanded for us to do. The question said the purchase consideration was settled by a share exchange of 2 shares for every 3 acquired shares. So if it's 2 for every 3 acquired shares, what will be the ratio, the fraction we are going to use? What's going to be the fraction?
So,
Whose hand is up? Yeah, Kunta, go ahead.
2 on 3.
2 on 3. That's good. So that will be 2 on 3. So yeah, it will be 2 on 3. Then we are supposed to multiply by the shares we acquired. How do we get the shares we acquired? Remember, we already did something like that. It was 60% on the 18,000. We did that when we were doing the deferred consideration. Let me take that back for those. So we did that the same thing here, 60% on 18,000 give us a share acquired. So the same procedure, 60% on 18,000 will give us the shares acquired. Then we multiply by the price for the share exchange. Yeah, we're told that the price of Kingdom at this date was 3 Ghana cedi. So we are going to multiply by 3. What will be our answer in that case? Yeah, go ahead.
21,600.
21,600. Then we come to the deferred consideration. The deferred consideration we have already calculated for the opening balance already. Bring the opening balance figure. That was this figure that we had here. 2 700, yeah, 2,700. We'll bring that figure here. So these were the purchase consideration we had in this question. We sum the two together. Then we come to NCI at acquisition date. We say here you have to check if it's proportionate or fair value. So we go into the question. The question gave us information in respect of that over here. VIII. It says the policy of Kingdom Limited Group to value NCI at fair value. At fair value. So here we are using a fair value approach. I remember fair value approach is two ways. Either they give you the value or they give you the price to calculate with. So you check in this question, we're given the price. We are supposed to use the price to calculate for this. And if we are using the price to calculate for this, you pick the price, which is 2.5 in this case. So yeah, the price is 2.5 in this case. And then we multiply by the number of NCI shares. So you remember that you multiply by NCI shares. How do we get the NCI shares? You know the percentage for NCI is 40%, and then the number of shares is 18,000. This will give us the NCI shares. We do that to get NCI at acquisition dates. What will be our resultant answer? Yeah, go ahead.
1,000.
It's a 18 or 8,000.
Yeah, 18,000. 1 8.
Okay. Then we sum the two together. It means with this plus this. and this will give us goodwill. Then we check if we have impairment on goodwill. The next question, we're giving the impairment on goodwill. So we just bring that. Yeah, let me check. I think it was 200 or so. Oh, I've forgotten. Yeah, it was here, 1 million. Yeah, 1 million. So our impairment here was given as 1 million. So let's that in that case. So that will be 1,000. Then we'll get 5,300. So this becomes our current amount of goodwill. Then move to the next one, NCI. So for NCI, remember you bring your NCI at acquisition date. That's the first thing you bring. You bring this value first. The next one, you bring NCI share of post acquisition. So you bring NCI share of post acquisition profit. NCI percentage is 40%. You take a share of the post acquisition. So yeah, the post acquisition we use the total 4,000 because it will share in the profit and also will share in the NCI, the revaluation. So we use the total 4,000 in this
So
case.
please, there's a slight mistake.
Okay, where?
So please, the um fair value of NC at acquisition. So don't we add it to the um consideration?
Mm-hmm.
Fair value. Where are you talking about?
The 18,000.
The
Oh,
answer is acquisition.
yeah, yeah,
Yeah.
yeah, yeah. And our layer is the net asset, right?
Yes, we
Yes,
didn't let
I
please.
didn't do that. Okay. And then layers the net assets here. So that's this figure, 30,000. Then we get this. So this should be the figure rather. So this is our goodwill on acquisition date. Then we less our impairment. So this should be the right figure, right?
Yes, sir.
Okay. Then let's come here. 40% of 4,000. What are you going to get? Yes, go ahead.
So 1,600.
1,600. Then yeah, are we going to bring impairments here? Are we going to bring impairments here?
Nope. Yes.
Yeah, we are going to bring NCI share of impairments. Be- because we are using fair value, right? Remember, NCI is being valued at fair value. So that's the reason. So yeah, it's going to be 40% on the impairment figure, which is 1,000. What do we get? 400 off.
Yeah.
We sum it together. So this becomes our NCI value. Question on this? Okay. Move to goodwill. So we're now with good. Move to group retained
Hello, sir.
earnings. Yes, please. Let me finish. Let me finish this one before you can continue.
Okay.
So parents retain earnings. So with group retained earnings, first thing bring your parents retained earnings. Yeah. And then parents retained earnings, yes, 12,600. Please mute yourself. I'm getting feedback. So that's 12,600. The next thing we do is parents share of the post acquisition profit, which is 60%, which is 2,800 in this case. So we bring that here, 2,800. What do we get?
One six eight zero.
1680. Okay. Then we bring the parent share of impairments, which is also 60% on the impairment. Impairment was 1,000. So that will give us 600 in that case. Then the next one is finance costs. Finance costs on the deferred consideration. So remember we had a finance cost over there. We were going to bring it. So this was the finance cost figure 203. Record that is an expense, so show it as negative. Then we had provision for unrealized profit. We already calculated for this, so let me just go and see. That was what we sent to the top here. 1,000. So someone just calculate for us. It was 1,200 multiplied by
240.
25,045. That's
40.
240. Okay. So bring that there, 240. 240. I think that was all. That was all. Then we sum them together. Okay. So we are done with the group retainers. Next will be the group evaluation surplus. Yeah, we had a revaluation, so we have to do a group evaluation surplus.
Hello, sir.
Yeah, you had a question. Yeah, go ahead.
Sir, I'm asking whether the finance cost on the deferred consideration is it the same as the unwound interest?
Yeah, it's the same thing.
Oh, okay. Thank you.
You're welcome. This
So
one,
please, I didn't hear his question.
it's asking whether the unwinding of the discount is the same as finance cost, and I said yes. Vincent, your hand is up.
Yes, please. Sir, please, I want to ask question on impairment of goodwill.
Impairment on
I
goodwill.
want to ask that instead of, yes, please, treating it under NCI and group retained earnings, can you simply add it to, can you simply subtract it from the net asset of subsidiary?
Net asset of subsidiary. Why will you do that?
Yes, please.
No, I disagree. Oh yeah, maybe there have been alternative solution that way, but the right thing is here. It's supposed to be on your goodwill value. So you can't go and treat it there.
Okay,
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 Eric, your hand is up.
okay, okay. Thank you very much. A mistake. Sorry.
Okay, then put your hand down then. Johnson, your hand is still up. If you're not asking a question, put your hand down. Okay, so let's make headway. So we move on to group revaluation surplus. First, we bring the parent revaluation surplus. Yeah. And then the parent revaluation surplus is 4,000. So we bring the 4,000 here. Then we bring the parent share of the revaluation. Parent's percentage is 60%. And then post acquisition revaluation, we had 1,002. So you bring it there 1,002. What do you get?
720.
720. Then we sum the two together. That will be 4,720. So we have most of our workings here. We just fill it out in the statement. So yeah, we'll start with goodwill. We already know the goodwill value here. We are going to pick it up and bring that. So goodwill, we had 11,300. The next was PPE. We check if PPE during the year there was a fair value. And that one, when we check our net assets, we realize there was a fair valuation of our PPE by 8,000. And then there was a depreciation in that regard. So it's going to be plus 8,000 minus 200. We'll show that one under our PPE plus 8,000 minus 200. I think that was all. What's this total? Yeah, the revaluation. I didn't forget the revaluation too. We revalued our property within the year, so it wasn't part of the PPE value. That 1,200, it wasn't part of the PPE value. So we will do that in that regard before we find the total. So what will you get? What will be your total?
74,200.
74,200. Okay. Next, we have loan here. Remember they made mention of this loan in this question. Yeah, say Kingdom on December 2019 accepted a 1 million loan note. So this is intra-group loan. Intra-group loan. So we need to de-recognize this from our book. So one party will record it as an asset, another party will record it as a liability in here. So we need to less the values in that case. So yeah, we'll less 1,000 over here. Then when we come to this aspect, we less the 1,000. So 2,000 minus 1,000, what will we get? That'll be just 1,000. So we just bring it there. And then we sum this up. Then we come to the current assets and see if there's anything that will affect this aspect. So number one, inventory. Remember your provision for unrealized profit will affect it. So we recorded that in the group retained earnings. We'll pick it up. So provision for unrealized profit was 240. We recorded here. 240. Then we check if within a year we had intra-group, we had goods in transit. We check if we had goods in transit. I think I saw a cash or goods in transit here. Okay, that's additional information. But yeah, I said we do want to get to the position. Yeah, so can we get a reader to read this one for us? Is Felix here?
Yes, sir.
Yeah, go ahead.
Note B. At 31st December 2019, Kingdom Limited had a trade receivable balance owing from Paradise Limited of 2.4 million. However, this did not agree to the equivalent trade payable of Paradise Limited as a result of a payment by Paradise Limited of 800,000 made in December 2019, which did not reflect in Kingdom Limited bank accounts until 4th January 2020. Kingdom Limited's policy for cash timing difference is to adjust the parent's financial statements.
So this relates to cash in transit. The question has clearly made you aware that cash in transit. Because you made mention of the bank accounts. That's one clue. Another thing, you also made mention of cash timing differences. That should let you know it's cash in transit. So yeah, we don't have goods in transit, but I rather have cash in transit. So we'll do that in that respect. How do we go about this? Remember we said the receivable one you less from the receivable, the payable you less from the payable. The difference becomes your cash in transit or goods in transit. In this case, we have cash in transit. So yeah, trade receivable balance, we're told that it's 2.4 million. So when we come to trade receivable, less the 2.4. Then next, we were told that it did not agree with the balance in the payables. The payables ones was 800,000. So when we go to the payables, we less 800,000. We less 800,000 in that case. Then the next thing is for us to account for the difference as a cash in transit. So what's the difference? 800 and then 2,400. What will be the difference?
1,600.
1,600. Right? So 1,600. But look at what we have here. We have 600 here. I said 1,600, 2,400 and 800. Yeah, okay, yeah, that will be 1,600. Let me check this thing again. Oh no, I don't think it's 1,600. Let's read this aspect again. Is it Paradise Limited as a result of a payment by Paradise Limited of 800,000 made? So this one is a payment. So yeah, they gave you the difference rather. Yeah, so they gave you the difference rather. That means that the balance in the payables should rather be the 2,400 minus the 800, which would be 1,006 rather. So the payable balance is rather 1,006, and then the cash in transit is 800. So yeah, this is the payment that did not reflect in the bank account. So this is a cash in transit rather, 800. So let me change that. Yes, instead of 800, it's going to be 1,006 instead. Then the 800 will now be our cash in transit. So the cash in transit, as you know, we are going to add it here. That's the difference, 800. I think that will be all right.
Listen.
Yeah, that will be all. Okay, so let's find for the respective totals for each
Hello, sir.
inventory. Let's get the totals, then I'll pick your questions. Let's finish with the totals.
Inventory is 10,760.
760. And then trade receivables.
12,000.
12,000. And then bank.
2,200.
Bank is
Did you say 2,000 or 1,000?
1,400.
Hmm.
Sorry. So this will give us our total assets before it comes to finance by. Yeah, so someone had a question.
Yes, sir.
Yeah, go ahead.
Okay, so my question is just a clarity on the. You said there is no goods in transit, but then in the PNL, we saw that they made intra-group sales of the 600 times the 9 months, which is 5,400. And then in additional information, they said the kingdom supplied 1.2 million. So is it not is the difference not the goods in transit because they only
No,
supplied? Okay, can you
this
please clarify on that for me?
that was the that was the closing inventory from the intra-group sales. Yeah, this was it. A total of 1.2 million at the cost to Paradise Limited's inventory at 31st December had been supplied by Kingdom. So this was out of the intra-group sales. This was what was left. And they'll give us this figure to help us calculate for provision for unrealized profit. Not this is not goods in transit. If it's goods in transit, the question will let you know that the receivables, the payables supply certain things to us. We are yet to receive it. It will give you those information so that you can get to know that that is goods in transit. But it is not.
Okay, sir. Thank you.
Okay. Yeah,
Okay.
Felix, yeah, go ahead.
Yes. And so with the still with the transit, if we use the net of it as the current liabilities for trade payables, and then the trade receivables, we are still using the 2.4.
Yeah, because that's the balance.
Mm,
Yeah, that's the balance. They told us that Kingdom Limited had a trade receivable balance going from Paradise. That was the balance going from Paradise, 2.4. But yeah, instead of them to, the usual question, instead of them to give us a trade receivable balance, so that we look for the difference, as either cash or goods in transit, what they rather did was they gave us the payment. They said Paradise made a payment of 800,000. So into that effect, it means that how much were we owing before this payment? So that would be the difference.
so yes. Okay.
Yeah, so that would be the difference. So how much we're owing after will have been 2.4 million minus the 800,000. So it means that now we are owing 1,006, right?
Yes. Yeah.
Yeah. Okay. Jones, you want to still up? Okay, I'll take the last question, Isaac. Then we move on. Isaac, yeah.
Sir, so what about instead of having this footnote, you have something like a current account on the statements of financial position? How do you treat it?
Isaac. So if you have a current account, the same way, if it was goods in transit, you have to add. If it is a trade receivable, you have to less, right? If it's intra-group account balances, you just go and less it. So the same effect will be the same thing you do here. So that's it. Too. If you have been given a current account balance instead of them giving to you separately, what was the effect you did here? So yeah, the trade receivables you subtracted 2,400. So when it comes to if they give you a combined figure, comes your current assets, you less the 2,400. You have the bank, you have the cash in transit, you add it to it. That's all. Okay, let's make headway. So yeah, we have a share capital here, and the share capital here, you check in the question if you have a share exchange. Because share exchange is one of the items that will affect your share capital. And in this question, we're having a share exchange, right? Because we did a share exchange over here. And the value was 21,600. So we'll add this to the balance we have there. So this is 21,600. This will give us 41,600. The next is revaluation surplus. Revaluation surplus, if we have done the group revaluation surplus, we just pick the figure, which is 4,720. Then we come to the retained earnings. We already have that. We'll pick that as well. Yeah. Then NCI, we also have done that already. And we sum them together. Then we calculate for the loan value 5,000 plus 2,000 minus 1,000. What do we get?
6,000.
6,000. Okay, we come to trade with payables here. Yeah, remember we're having deferred consideration. It was for 1 year. If it's 1 year, it's just current, right? It was just for 1 year. But if it is for 2 years, you treat it as a non-current liability. So yeah, we just add it to our payables. It's part of your payables, other payables. Some might show it for as a separate line item. You can go ahead and show it as a separate line item, or you can just add it to your trade payables. So let's sum the trade payables up. What do we get?
Fifteen three zero three.
We get what? Come again?
303.
15,303.
Yes.
Okay.
Hey,
Bank
the
over.
screen is buzzing.
You were saying something? What? Income tax payable. We'll get what? So,
Your screen is on. Yep.
yeah, Eric. Yeah, Esther.
Sir, please, I wanted to ask where we got the 29034. I didn't get that.
The receiver that's prepared. That's the value.
So we added it to the J- yeah.
Uh, why? What do you think we should do? It's not a
I was
liability.
thinking we treat it as a line item.
That's why I said I
Oh,
said
okay.
you can choose
It's
to treat it as a line item, or you can add it to your payables.
unless I didn't hear.
Okay, Abigail.
Yes, sir. Please, so the 1,600, that was the difference for the payables and the receivables. I don't know why we are, I want to get why we are subtracting it from the payables, and then when we went to the receivables, we're adding the 1,600 to
Did I add
that.
something over there? Get your facts right. So I didn't add anything to this. I rather let,
Sorry, rather less the 2,400.
yeah, so that's how you do it. That's the balance that you was owed to the other entity in the intra-group transaction. It was 2,400. You are a family now. If you're a family, you're not supposed to owe the person. So you subtract the 2,400. And then here they give us the that during the year there was a cash in transit. So if you were to get the amount you are now owing, the other party will now be owing to be 2,400 minus the 800. That was to give us the 1,006. And the 1,006 here to you have to let it from the trade payable balance because you are no longer you're a family. You shouldn't owe each other. So you less the 1,600.
Oh, okay. So we are lessening it because now they are together.
Yes.
Okay.
Johnson. Okay, Johnson is not asking a question. That's fine.
So I've asked
Amewo
my question already.
Amewo
Sorry.
Amewo I think Amewo Ben, yeah, Ben.
So please, my question has to do with the share capital. The price of the share capital is above the nominal value. So why don't we split it into share premium, share capital?
We don't have share premium in our question, so there's no need for that.
Okay.
Yeah, and even the Ghanaian system doesn't record share premium. You only do that when you have a share premium separately and you have supposed to split. That one you are mandated to split.
Okay. Okay. Thank you.
But in this question, we don't have share premium. So there's no need for you to split.
Thank you.
Okay, I think the questions are enough. Let's move on. 5,600 plus 1,600. What do we get?
7,200.
7,200. Then we sum it together. Let me see. Is it balancing? It's balancing, right? Yeah, it's balancing with what we have here. So we'll close the chapter on console. So this is on the position. This is on the position. So we'll close the chapter on that. We'll start with the air power standards. We'll look at some key standards we have. Look at some key standards we have. Yeah, David, now that your hands is up, yeah, go ahead.
Yes, sir. Okay. I just need some clarification. It's two. I read some book on the revaluation. It's saying that when there's a revaluation difference, you shouldn't write it at the post acquisition period, but you should share it and treat it under group within earnings and NCI.
Okay,
And
but we have
then
done that. We have done that, right?
yes, but this particular one, I think we wrote the post acquisition revaluation difference at the post
Yes,
acquisition period. I don't
you are
know.
correct. We did that, and then we still accounted for that, right? By sharing, right?
Yeah, we did the sharing, but actually wrote it under the post acquisition period. That is where I don't. I need clarification for.
And that's why when I was done, I splitted it again. So it's the same thing you're asking. You're asking me
Oh,
what
okay.
you're asking me why I split it, and you have given me the answer that you're supposed to split.
Yes,
And so that's why we separated it.
but won't it affect the post acquisition period?
That's why
How do you
that's
call it?
why
The
that's
profits.
why we separated it so that we can get just for the profit and just for the revaluation.
Okay. Then my second question is the this consolidation that we are doing. I think it's for the first time consolidation, and after the consolidation, maybe the parents has acquired the subsidiary. The subsequent years, how is the account prepared? Is it the same thing or is prepared a different way?
So if you're asking, is it the same thing? Which the same are you asking of? You definitely
Like
have
the
to
same
report.
consolidation we are going to do the subsequent
You
years.
definitely have to report you have to do control structure. If you're dealing, you definitely have to know the control structure. You have to know your carrying amount of a goodwill. So if any impairment has occurred, the same procedure, you subtract the impairment to get a carrying amount of a goodwill. NCI, you definitely have to know your NCI value. The group
Okay.
retained earnings, you also have to know the group retained earnings at the end of that period. So yeah, the only thing I think your question should have been that what will have been the additional things you have done
Okay.
aside the
Okay.
normal one?
Sure. Sure. In the subsequent years, yeah.
So subsequent years, you calculate for your subsequent profits. You
Okay.
share it again, right?
Okay.
For both the parent and that of NCI. If it's a subsequent revaluation, you share it again for both the parent and then NCI. And if there's any gains or losses that arise within a period, you're going to account for it. So
Okay.
if it's the parent's gain, where will it go to? To go to group retained earnings. If it's for the subsidiary, where will it go to? You can do a revised net asset schedule for
Okay.
that piece. Yeah,
Okay.
so the same procedure, just that you account for the new ones as and when they occur.
Okay. Okay. That's fine.
Yes, sir.
Sir, please, you said anytime we have share for share exchange, that means you have additional shares.
Yes,
Sir, please, do it always.
yes.
Thank you.
Abigail. Okay, Abigail's hand is down now. So let's start with the standards now. Let's start with the standards. Okay, so we first start with the first standard here, IFRS 15 here first, and then we move to the others. So IFRS 15, what must you know? There are two things under the standard you must know. You must know the 5 step for revenue recognition. And then next one, you need to know how to account for construction contracts, which is tied to the overtime of revenue. So these are the two key things you need to know. You need to know the 5 step procedure. You can be asked theory, you can be asked calculative questions in that regard. So we'll do a recap of the 5 steps. What are the 5 steps we have? As I said, it's a revision class, so we are just revising. So what are the 5 steps to revenue recognition? Okay, hand is up. Yes, that. What is step one?
Uh, Identifying a contract with a customer.
Identify the contract with a customer. Okay, another person, step two.
Step.
Identify the performance obligation.
Your hand is
Hey.
not up. Your hand is not up,
My
so
hand is up.
Identify the
I didn't hear your
transaction.
answer.
My hand is up.
Uh, Isaac, here, your hand is up now.
Performance obligation.
Identify the performance obligation. Step three. Yeah, Cosina.
You identify the transaction price.
You determine or you identify.
You determine.
Yeah, determine. Determine the transaction price. The fourth one. Yeah, Cosina again.
Allocate the transaction price to the performance obligation.
Allocate the transaction price to the performance obligation. So maybe it's PO to the performance obligation. And the last step, Step 5. Esther.
Recognize revenue as and when the entity satisfies performance obligation.
As and when. Performance obligation. Okay, that's good. So this is the 5 step. And then the first step is that you should know is that whenever you are given a question on revenue and it's 5 step, you are required to use the 5 steps to answer. So take note, if you have a question that demands revenue and you realize that it is the 5 step procedure, it's a separate line item question. It's a question on its own, and you are required to answer using IFRS 15, the revenue process. Then you need to use the 5 steps to do that. If you don't do that, you lose ticks. The examiner will not give you all the ticks in that regard. So we have a question here. I'll read, are you there? Oh, yeah, tired.
I'm here.
Okay, let's
Okay.
go. Question 1.
Um, okay. Question one. Nigeria Limited is a manufacturing and retail company which prepares financial statements in accordance with IFRS up to 31st December each year. In order to generate or improve sales on one of its older products, Nigeria offered a promotion named Something for Free. The promotion included free maintenance service for the first 2 years. On 10th October 2019, under the promotional offer, Nigeria sold goods to a supermarket chain for 4.4 million. A 2 year maintenance contract would normally be sold for 0.5 million, and the list of the products would normally be 5 million. The transaction has been included in revenue at 4.4 million. In accordance with IFRS, justify the appropriate accounting treatment for the above transaction in the financial statements of Nigeria for the year ended 31st December 2019.
Okay. So thank you, Rita. So yeah, what do we do? Once you identify that this question deals with revenue, you're supposed to use the 5 steps to answer. Most of the time, if you check the chief examiner's reports and then their marking scheme, you realize that most students go straight to answering the question without using the 5 steps for revenue. If you do that, you lose ticks in that regard. So yeah, you have to use the 5 steps to look for that. And what's the 5 step? The first step is we need to identify the contract. So we check in the question and we ask ourselves, is there a contract? So we are solving the IFRS 15 question 1 here. So first thing we ask ourselves, is there a contract in this question? Is there a contract in this question? And what will let you know that there is a contract? You are supposed to use the 5 criteria to identify that. So in exams case, you can just mention 2 that you see visible in the question and use that as your justification for a contract. So what criteria do you remember? Or which one do you see in the question? The 5 traits to identify a contract. Which one do you see in the question? Oh, no hand is up. Faustina, yeah, go ahead.
So the identification of a contract with the customer,
Mm-hmm.
which is the drawer sold goods to a supermarket chain for 4.4 million. So I think you find the contract with the customer there.
Yeah, I understand you, but you don't answer it that way in exams. You answer using a criteria for identifying a contract. You have criteria for contracts. Uh-huh. Is Jerry around? It's been a while. Okay, I think it's not around. Yeah, Felix, go ahead.
So we can identify that there are two contracts here. That's the yeah. the maintenance service, and then the sale
No,
of
no,
the.
no, 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 no.
Hey, my
Esther,
Sir, please, I wasn't following. Please, the question you asked is it still on
follow
how to
as you
identify a
understand.
contract? So I
Follow
had
as
a
you
call,
understand.
so I
Vincent,
went off.
follow as you understand. Next time, don't have a call. Vincent, let's go on.
Okay, sir, there was a contract. That is, there was an agreement between a Ejra and his customer to sell and
So
to
there's an
sell
agreement,
and
right?
do a maintenance.
Yeah, so you're right. There was an agreement. There was an agreement. You're right. So one of the ways to identify a contract is when there is an offer in acceptance. Okay, that's fine. Ben, yeah, you understand?
Um, the contract has a commercial substance. Or it has
Exactly.
commercial.
The contract has a commercial substance. One party is trading to make profit, so the contract has a commercial substance. Each party to the contract have been identified and are committed to perform. Those are the criteria you write. And my people, go and do your revision, So step one, that's what you write for step one. So step one, you basically tell us that there is a contract because then you add two reasons to it, then you're done. So that's how you write for step one. Let's go to step two. Step two stipulates that we should identify the performance obligation, right? Identify the performance obligation. So let's check how many performance obligations do we have here. How many performance obligations? Vicent, is your hand up or is it from the old one?
Yes, please. Two contracts, two performance obligations, sir.
Okay, there's two performance obligations. Okay, thank you, Vincent. What are they? A different person, what are they? Yeah, Abigail.
With a 2-year maintenance contract.
So a 2 year maintenance contract. Okay, and what else?
And
Hmm.
then the sale of the goods.
The sale of a goods. So yeah, you're right. So it's two. So someone will say sale of products, sale of goods, still the same. And then the maintenance contract, which was for 2 years. So maintenance service, which was for 2 years. Okay, the next step is determine the transaction price. So what is our transaction price? The next question. Uh, Felix, your hand was up first. Go ahead.
the transaction price is 4.4 million.
Exactly. We're told here that Jura sold goods to the supermarket for 4.4 million. So we bring that there, 4.4 million. That was the transaction price. Then step four is the allocation. Now, how do we allocate? According to the standard, how are you expected to allocate? Yeah, Felix.
So we first allocate to any good that is worthless, then impairment.
Relax, 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 relax. You're not doing impairment, but relax.
Hey, I'm getting it.
You're going to impairment. You're not doing impairment.
Wow.
Yeah, Isaac,
You have to allocate it pro rata
pro rata. What's the meaning of pro rata?
according to their individual values.
Okay, what do we call that individual values? Okay, maybe I'm asking too much.
They
So
are
they're right.
standalone. They are standalone
That's what I
products.
was looking for. The standalone selling price. So the standard says you use their relative standalone selling price. So yeah, we know our performance obligation here in the question should be two, which we have identified as the sale of goods and that of the maintenance service. So I'm using a tabular approach to solve it. The next thing is that we need to know their individual standalone selling price. So what their standalone selling price is for each. So if you are selling the product alone, how much will it cost? If you are selling the maintenance service alone, how much will it cost? So let's check in the question. If you are selling the product alone, how much will it cost? From the question, if you are selling the product alone, how much will it cost?
5 million.
5 million. So that's 5 million here. And what about the maintenance service?
0.5 million.
Isaac, you understand? Go ahead.
0.5 million.
0.5 million. Then we say when you're done, you find the total for this, and this will be 5.5 million. So when a standard says use the relative standalone selling price, it means that you find a relative for each. To get a relative for each will be 5 million divided by 5.5, and for maintenance service to be 0.5 million divided by 0.5. Then you do the allocation for them using their relative. And the allocation, they are all sharing transaction price. So you are going to use that to share. So the first one will be 5 million divisible by 5.5 million. Then they are all sharing 4.4 million. Then do that for the second one, 0.5 million divisible by 5.5 million, and they are sharing 4.4. What do you get as the respective transaction price for each? So what do you get as the transaction price for each? A hand is up. Yeah, Eric,
Yes, sir. So for sale of products, you are getting 4 million. And then
4
for the
million,
service,
4 million,
yes,
and then the
service, you are getting 0.4 million.
0.4 million. So the total should give you your 4.4 million back
Okay.
in that case. Then go to step 5.
But, sir, in the this one, you are saying the service is for 2 years.
Relax, relax, relax. Let's go to step 5. So step 5, we are supposed to account for revenue. And then the revenue, we have to performance obligation. Now we need to identify the one that is at point in time, and we need to identify the one which is over time. So in the question, which one is tied to time? I always tell you the one that is always tied to time is over time. The one that is just given to you as you just sold it and got this amount at that point in time. So Eric, is your hand up again? Or is from the old one? Abigail, your hand is up. Is it from the old one?
It was a question, but you let me
Yes.
answer.
Okay, if you are answering them fine. But if it's a question, you have to wait when you're done. So yeah, you can go ahead, answer.
The goods was the point in time. That's the sale of the goods, and then
Which one was
service
over time?
the service is over time.
Okay, that's good. So if it is at point in time, or at point in time when you sell, you realize the revenue. So yeah, the 4 million here becomes the at point in time revenue because it's at point in time. But for the maintenance, that's Abigail rightly said, it's over time. So that one is based on time. So if that one is based on time, we need to know the period that the amount of money is for. And we're told that yeah, the maintenance service is for 2 years. Meaning that the amount of money we are only going to realize the full amount in 2 years' time. So the maintenance contract we have here, which is 0.4 million, is for 2 years. It's for 2 years. Now we need to check the number of months you have done so far in this question. How are you going to get that? The day that we signed the contract or the day the agreement was reached was 1st October 2019, and the day we are reporting. We get to know the difference in the months. So let's do that. 1st October 2019 to 31st December 2019. How many months is that? 1st October 2019 to 31st December 2019. How many months is that?
3 months.
3 months.
3 months. So it means that here we can account for the revenue for 3 over 12 times 0.4 million. What are you going to get?
Please, is it not 3 out of 24?
24.
Since
Yeah. Sorry, 24. It's 2 years. So 24. Thank you for the correction. So it's 3 over 24 for the first 2 years. So 3 over 24 times 0.4. What are you getting?
0.05.
0.05. So 0.05. So here we get 4.05. So this becomes our revenue. But in the question, they indicated that they rather recorded it 4.4 million as a revenue. So you indicate that the 4.4 million that they recorded was wrong, but the right amount of revenue should be 4.05 million. Okay, I'll pick questions starting from Abigail. Yeah, Abigail.
Hello, say.
Mm-hmm.
I think I forgot my question. When I remember, I will say.
Thank God. Let's move on. Esther.
Sir, please, can you go up? I was my network was having issue. I couldn't see your screen.
Yeah, you Esther. uh, uh-huh. I should go back. I've gone.
Okay.
Uh-huh.
Sir, please to the just on myself.
You said you told me to
Sir,
explain.
please
You know,
step
you know
two.
how to explain, right?
Sir, yeah, I didn't see, so I was trying to do it myself. So I'm trying to confirm if everything was okay.
Is
So sir,
everything
please
okay?
step two. Step
Step
two.
two. Oh, okay.
Oh, okay. So, sir, please, I'm okay.
Yeah.
Sir, thank you.
You're not welcome. Okay. Let's move on to the next one. Question
Hello,
two.
say.
Abigail, you have remembered there?
Yes, please.
Okay.
Please, I want to ask, is it always that the question will be so clear on the cost of goods and then the maintenance, the service? You
Is
see,
always
this one was
the question will be
clear.
clear? Yes, the question will be clear or the question will give you information to get it. It's two ways. Either the question is clear or the question will give you information to get it.
Okay.
Okay, let's go to two. Is Arida around?
Question
Are you
two.
around?
Yes,
Uh,
sir. Question
go ahead.
two. XYZ company fits out nightclubs. The projects generally take a number of months to complete. The company had three contracts in progress at the year ended 31st December 2007, and details are as follows. So, ABC with the various costs, cost incurred to date, cost to complete, and then progress payment. XYZ company accounts for profit on its construction contract using the percentage of completion derived from the sales end as work certified compared to the total sales value required. Calculate the effect of the above contract upon the financial statements of XYZ company for the year ended 31st December 2007.
Okay, so this is what we had. This question is on the construction contract. So as I said, you see that you're using the 5 steps or you're doing construction contracts. So for the construction contract, it's tied to the overtime principle, whereby there's a project that is being constructed or is being done for a period of time. And for construction contract, I said it's not usually a step, but it's an approach to help you solve any construction contract question. I gave you some 4-step approach to do that for those in our class. So say whenever you're doing construction contract, the first thing you need to do is overall profit or loss, right? You need to assess your overall profit or loss. Second, we said you need to measure your progress. Third, we indicated that you prepare your statement of profit or loss using the progress. And second, you prepare your statement of financial position. And here you're supposed to account for the contract assets or contract liability. So I give you this 4-step approach to always help you solve questions that involve construction contracts. So in this question, we'll start from the first one. So question 2, we first have to get our overall profit or loss. So overall profit or loss, how do we get that? You check for your contract price. So what's our contract price? You have been given for each A, B, and C. So these are the respective prices for A, B, and that of C. So we bring that contract price. So we have A, B, and C. And I'll bring the currency sign here. See 3 zeros on top. So we bring the respective contract prices. Yes, 416, 416. Mute yourself, oh, mute yourself. Patrick, please mute yourself. 684, 684, and then 300, 300. Then we bring our contract costs, which is the total cost of the contract. Remember that this is going to be summation of your cost to date plus cost to complete. So let's do that. So A, cost to date is this, cost to complete is this. Let's sum it up. We'll get 320 plus 40. That will give us 360 over here. We move on to B. B is 540 plus 90. What do we get?
630.
630. And then C is 20 plus 220. That will be 240. Then we look for the difference between these two for each of them. So we always say that when you get overall profit, there's no problem. But when you get overall loss, that's where there is an issue. Because when you get overall loss, when you're doing a statement of profit or loss, you need to account for the loss in full. But yeah, luckily for us, we had overall profit in this case. The next thing is we measure progress. We said progress is measured in 2 ways, either the input or output. So we need to check our question. How is progress measured in our question? Is it the input approach or the output approach? Is it input or output?
It's input.
Input. That's wrong.
Hey, it's a percentage of
It says XYZ accounts for profit on its construction using a percentage of completion derived
please.
from
Percentage of
sales.
completion is output.
Percentage of completion is just percentage. It's a percentage of completion derived from, you didn't finish reading. You just ended there. Derived from what? Sales earned as work certified compared to total sales. Which one do we bring work certified? That's the output approach. So this question, I'm going to use the output approach. So using the output approach, first bring a formula. That will be work certified to date. Certified to date. Then divide by your total contract price. Then multiply your answer by 100. So your progress percentage, yeah, we need to do for each. So we'll do for A, the contract A. Yeah, we bring our work certified date, which is 312. Then we divide by the contract price, which is 416. So it's going to be 312 divided by 416. Then we multiply our answer by 100 to get that for A. Move on to B. B will be the work certified to date 456. 456 divisible by its contract price, which is 684. 684 multiplied by 100. Then C. C, yeah, we're not giving work certified to date, meaning 0 divisible by contract price, which is 300 times 100. So this will definitely be 0 here. What do we get for A and what do we get for B?
A is 75
75%,
and B is 66.6%. Or
66.6, 67 or 6%,
6-7%.
67%. So this is the progress you have gotten. Then we go to prepare our statements of profit or loss. So yeah, we start with revenue. How do you get revenue? So you use your contract price, yeah, which is 416. So 416 times, you do it for A, B, and C. So let me bring them on top so that we don't have to repeat for each. Uh, so let me do this for A. So A will be 416 times its percentage, which is 75%. That'll give it for A. B will be 66.67% multiplied by the contract price, which is 684. For C, we'll come to C. So let's calculate for A and B. What is the revenue I get for A and B?
The AC
A is 312.
1,
Two.
2. Okay. What
Yeah.
will
B
be
is 4, 5, 6.
4, 5, 6? Okay. Let's go to cost of sales. Now do you get cost of sales? Cost of sales is your cost to date. So you just bring your cost to date for each. Cost to date is 320. And then we have 540, 540, and then we have 20 here. Okay, now let me come back to the revenue for C. So C, since progress is not measured, the standard will always tell you that if progress cannot be measured, the revenue you are going to record here should be the same as your cost to date. So here, C's revenue will still be 20, so that your profit will be nil. So here, C revenue will just be 20. But the standard says that if you can only measure progress, then you're calculating for revenue. Revenue should just be the same as your cost to date. So we have done that for each. Then we look for the respective amount. Oh, wait, let me do this for. So this becomes gross profit or loss. So this one we are getting loss, so gross loss. This becomes gross loss and then nil profit. Then go to the last approach, which is statement of financial position. Yeah, you're supposed to account for contract asset or liability. You do it for each as well. How do you get contract asset or liability? You first bring your cost to date, bring that figure first. And cost to date, we know is here 320, 540, and 20. You add your profits, that's your gross profit or loss. Yeah, we had a gross loss, so we'll just bring it here and bring them in that regard. Then next, you less your bill to date. So bill to date is the amount that we have received so far from the customer. So we need to check in the question if you have received any payment from the customer. So yeah, they have told us that we received 250 from contract A. So we less the 250. The second one we received 480. So we less the 480. And C, we didn't receive any amount, so that's zero. Then you calculate to get a contract asset. If you get positive, it's an asset. If you get negative, it's a loss. It's liability. So yeah, I'm sure it will be assets. So if you sum them up, okay, we had a loss for one. We had a contract liability. So you're going to be contract assets or liability. So the negative one is a liability. If you get a contract asset to go to current assets, you get a contract liability goes to current liability. And then you are done. I think so far in the syllabus, the examiner has not tested construction contracts for FR. I think for CRE it has been tested, but for FR so far, we have not seen. So one of these days, the examiner can get excited and examine that. Okay, so there are questions on this. We'll pick them. Okay, Jerry. Hey, Jerry, you're back.
Yes, sir. Thank you. Please.
You stayed there well.
Yes, so I've been away on
Okay.
assignment.
Okay.
Please, the percentage, the output determination of the percentage. There's 0% for the C. Does that mean the work is there to commence, or they've commenced and they've not made any
So,
progress?
yeah, if you're looking for qualitative reasons to support that, yeah, it could mean that probably the work has not yet gotten to any level that needs to be certified. That's why it may be zero.
Okay, thank you.
You're welcome. Any other? Okay. Then let's move on to the next standard. IS 36
Hello, sir.
improvement. Yes. Okay.
Please, if this one is the hello,
Yeah, if this one is, yeah, Eric.
out, yeah, if this one is the how do you call it, the output? Please, uh, uh, how do we type?
Yeah, so the formula for the input, right?
Yes.
Okay, to get the formula using the input approach, input uses a cost. So the input percentage here to be your cost to date divided by your total estimated cost. And you know the total estimated cost, right? I spoke about that when we did the step one. That contract cost, that's your cost to date, cost to complete. That gives you your total estimated cost. Then
Yes.
you multiply it by 100. So that's how you go about it for the input approach.
Hmm. Thank you.
You're welcome. Any other? Abigail, your hand is up.
Yeah, I was not really getting the contract thing.
Oh, and sorry for you. I think maybe when you're done, we can talk later or maybe watch the recorded video. As I said, it's a revision class, so I won't be able to do the usual thing I do in class.
Okay.
Yeah, Jerry, your hand is up again. Jerry, your hand is up. Or is it from the previous one? Okay, hand is down now. Okay, so let's move on to the next one. IS 36 impairment of assets. So, yet, what should you expect the examiner to test you on? The examiner can test you number one on theory, and the examiner can test you on the conditions for the indications of impairments. You know, we have the internal and then external conditions, so you should know that theoretically. So, you can test you theory on that. Number two, the examiner can test you on an impairment on a single asset. So when you have an impairment for a single asset, single non-current asset, you can be tested on that. The examiner can also test you on cash generating units. And then lastly, the examiner can test you on reversal, reversal of impairment. So if you are reversing impairment, how do you go about that? So reversal of impairment. So these are four things the examiner can test you on. So you need to know the theory over here, especially the conditions for impairment, the internal and external conditions. The examiner can also test you on the single asset. How do you account for impairment for a single asset? The examiner can test you on cash generating units. And then lastly, can test you on reversal for impairment. So we'll first start with the measurement rules. Since we are about to solve the question, let's just focus on the measurement rules. So first thing is you have to know the condition for impairments. You always have to check the condition before you even calculate for impairment in the question. And what's the condition for impairment? Condition for impairment. Abigail, your hand is still up. Do you want to answer?
Well, okay. So maybe when there is a um obsolescence, like a physical
No. Those ones are indications. I'm talking about the condition before when you're solving question, the things you check. You have to check before. So what you're saying is the conditions, the theoretical conditions. Yeah, Vincent, go ahead.
Okay, so I think we have internal and external conditions.
I'm not asking for the theoretical conditions. So yeah, I get you, but I'm not asking for the theoretical condition. I'm asking for when you're solving question. The first thing you check, you have to check whether there is an impairment, the indication of impairment, and what is the criteria to check in the question. Oh, Esther, it's been a while. Esther, you're honest, I've go ahead. Okay, I think Esther is muted. Isaac,
Okay,
So
so
is
I
it the
think
recoverable?
you
Isaac, go
check the
ahead. You go
carrying
ahead.
amount, you check the carrying amount and the recoverable amount.
Okay, so what do you check over there?
So you check to see if the carrying amount is more than the recoverable amount.
So you check if the current amount is greater than the recoverable. So that's the first thing you check in the question. So in the case whereby you check and you realize that this condition is not met, what will be your answer?
Means that it is not impaired.
It means that there is no impairment. So this is the first condition you check before you solve any impairment question. You check if the current amount of the assets is greater than the recoverable amount. So if you check and then it doesn't meet this condition, then your answer will be that there is no impairment in that particular question. So that's the first thing you do. Then next, you calculate for the impairment itself. So impairment here will be the current amount of the assets, you less the recoverable amount. And how do we get recoverable amounts of the assets? How do we get recoverable amounts of the assets? Yeah, some hands are up. Jerry, go ahead.
Is the higher of fair value or
Higher of
value in use? So,
fair value. Okay. And less cost to
the
sell.
less cost of
And what?
value in use.
And the value in use. Okay, so you check for these ones, the ones which is higher, and then you pick that. Okay, so these are the few things you need to know in terms of the formula, so that whenever you're calculating for impairment, you'll be able to calculate in that regard. So let's start from question one.
Hello, sir.
Yes, please.
Sir, please, is value in use the same as net realizable value?
Value in use, the same as net realizable value. No,
Yes, please.
the answer is no. Net realizable value is rather the same as fair value less cost to sell. So net realizable value is rather the same as fair value less cost to sell. Value in use is the same as present value.
Oh,
Yeah, please mute yourself, Jerry. Mute yourself. Yeah, so let's go to question one. Yeah, Arida, please read for us. Is Felix around? Okay, I think she's not around. Someone should read for us. Can anyone read for us? Isaac, can you read for us?
Okay, sir. Question 1.
Yes.
Somni Limited is undertaking an impairment test for one of its cash generating units, which has a 3-year horizon. Somni has prepared the following list of budgeted cash flows for the purpose of calculating value in use over the next 3 years.
That's 31st December 2024 year end. Sumner's weighted average Sumner's weighted average real cost of capital that is adjusted for the effects of inflation is 8% per annum. All Sumner's cash generating units exhibit similar risks. Assume all costs Assume all cash flows occur at the end of each year. Required. In accordance with IAS 36, impairment of assets, explain the treatment of each cash flow above and calculate the value in use of the cash generating unit as at 31st December 2023.
Okay, so this is what we have. The requirements of this question is that we should explain the treatment of like each cash flow item, and then resultantly you calculate for the value in use. So value in use, as I said, is the same as present value over here. And before you can get a present value, you first have to get a cash flow. So we have to check each of the cash flows and we'll ask ourselves, are we going to consider it or we are not going to consider it? So we'll start with the first one, cash from sales. Are we going to consider cash from sales or we are not going to consider it?
Consider it.
We'll consider it definitely. We're going to have to consider cash from sales to get our value in use. So yeah, we are calculating for value in use, question one. So value in use. We have been told to calculate for that for three different periods. Let me see. Yeah. So we are calculating for 2024, 2025, and I think 2026. All at year end. So the first thing we'll bring the currency sign to. So Ghana C 3 zeros on top. So we bring our cash sales. Yeah, for each that's 2875, 2875. Next we have is 3000, 3000. And then the next one is 2250, 2250. Then we move on to the next one, cash pay to acquire inventory. Are you going to consider that? Cash pay, are you going to consider that?
No,
Is it a yes or no?
no.
No, Kwesi, why? Why are you saying no?
Well, I think according to the format, it says most of the times inventory is not impaired.
Inventory is not impaired. Hmm. Are you sure inventory does not impair? Inventory impairs in itself. The only thing the standard says is that the measurements for inventory already accounts for impairments. That's what we call write down. So in inventory, remember we do write down over there. Write down is the impairment for inventory. So yeah, we are calculating for the value in use. We still have to consider the cash payment for your inventory. It still has to be considered because that will give rise to impairments also. So yeah, we'll have to calculate for that in getting our value for use.
Please, can you come again with the explanation, please?
So the cash paid to acquire inventory is also a cash outflow from our activities. So as a firm, you get cash receipts. The corresponding for cash receipts is that you need to also have some purchases, things that you have purchased to produce your items or inventory you have acquired to produce your items. So these ones are major activities of a firm. So the cash sales and then that of the cash purchases specifically from inventory is part. I get your point by saying that inventory in itself The standard will tell you that inventory in itself accounts for impairment. Yes, that one is what the standard actually says. That inventory in itself accounts for the impairment because of the concept of write down. The lower of cost and net realizable value will indirectly account for the impairment. So that's why it says that when it comes to impairments for inventory, it's already treated in a separate standard. So you don't do that under impairment as a separate standard. But that in itself is an indication of or gives rise to impairment. So you need to consider that activity as well. So the cash paid will be considered. Kwesi, are you fine?
Okay, so because we are paying cash, it's a cash outflow, we will consider it.
It's not because it's a cash outflow. That's not the only reason. It's a major activity in our operation and it also gives rise to impairment.
Okay, okay.
Yeah, okay. So let me just put it this way. Value in use, yeah, we are looking at your cash flows. That FM you generate. So yeah, we consider your cash inflows and cash outflows. The only thing is that there are some items they are not considered as cash inflows and cash outflows when calculating your value in use according to the standard. So in this question, yes, definitely your cash purchases here will have to come here. Your cash purchases from your inventory. You definitely have to bring it here. It's a major activity of the firm. It gives rise to impairment for a firm as well. And here you can clearly see it's a cash outflow. So I like you saying it's a cash outflow. So we are going to subtract this figure. The cash from sales is a cash inflow. So that one we left it as positive. It's a cash outflow. So we are going to subtract. So we'll bring the figure here. That is 1437.5. Then we bring that for the others 1500. And then lastly for this 1125. 1125. So you bring it there as a cash outflow. We move on to the next one, wages and salaries cost. This one is definitely an expenditure for the firm and it's also going to be considered in calculating your value in use as well. So we are going to bring that wages and salaries. This one is a cash outflow too. That's 562.5. Then we have the same thing throughout. Yeah, the same thing throughout. And the next one we have is interest paid on loans. Are we going to consider interest paid on loans?
No,
No, why? Why? Oh, yeah, my students are here. Felix, yeah, your hand is up.
I think it's an expense that does not affect the cash of the company, so we wouldn't consider it.
Okay, you have tried. Jerry,
Okay, so my has to do with some clarification. Under the
okay, go ahead.
value in use, under the value in determining the cash flow to include, are we going to look at the operation of the firm?
Wait, I'm coming. Are you asking a question or you are answering our
Yes,
question?
it's a question. It's a question. I want some clarification. I'm getting
Let's
confused
let's
as
answer
well.
our question first before we bring another question, so that we don't swear away. Esther, okay, Esther, your hand is down now. Okay, Chrissy,
So it's in the standard that hello,
yeah, yeah, Esther, go ahead, go ahead.
hello. So in the standard cash flows from financial activities are not included in there.
How Exactly.
estimation of
So that's the answer.
value in use.
Cash flows from financing activities are not regarded. Cash flows from financing activities are not regarded. That's according to the standard. Well done. Kwesi, where you can say the same thing?
Yes, please.
Okay. So yeah, that's the reason. Yeah, Jeremy, now let's come to your question.
So my question is, when you are determining the value in use, the cash flow you should be included. I want to find out whether we are looking at the operation of the firm in determining, okay, this cash either inflow or outflow can be included in calculating the value in use.
Yeah, so you follow the dictates of the standard. The dictates of the standard tells you that you include all your cash inflows and outflows. That's what the standard says. But there are certain items that the standard says are not considered. So one of it, as Esther rightly said, is your this one, your cash flow from financing activity. You're not going to consider it. If you could quite remember when we're solving questions under impairment, we say you're going to use you're going to use is it pre-tax cash flows and pre-tax cost of capital, right? If you quite remember.
The
Yes.
pre-tax is the pre-tax.
So pre-tax cash flows and pre-tax cost of capital. We also said the cost of capital you use should be before tax. And
Okay.
we also made mention of you mentioned it was all in the notes. I think we mentioned the cash flow from financing activity. We mentioned cash flows from is it future reconstruction? I'm trying to remember some and many others. We mentioned quite numerous things that you don't consider when you're determining the value you use. So interest paid on loans is a financing activity. That's basically finance cost. We don't consider that when you're determining the value you use. It's one of the items excluded when you're calculating for your value you use. So as I said, you are just following the dictates of the standard in answering the question. Did you get it?
Yes, please. Thank you.
You're welcome. Okay. So we are not going to bring this. So this one is not coming. Let's go to the next one. Tax paid. Are you going to bring tax paid? Esther?
Sir, please, no.
No. Why?
So the standard says you should exclude income tax payments and receipts.
Yeah, so the standard says that the cash flow you use should be before tax cash flows. So tax payments and receipts are not considered. Okay. Next one, payments of restructuring costs. Are you going to consider that? I think I even mentioned this. So if you listen, I mentioned this today.
You just mentioned it that you won't consider.
Exactly. The standard says that any future reconstruction costs will not be considered when determining the cash flows. So you're not going to consider this as well. So the reconstruction costs will not be considered. Let's come to disposal proceeds. Are you going to consider disposal proceeds?
I think this is proceeds with a cash inflow.
Yes. So we are going to consider the proceeds 625. That's for the last year. That this one is an inflow. So we bring it there. Disposal proceeds. And this is 625. So we bring it there 625. Then you find for the respective totals for each. This will be your cash flow for each year. So our cash flows for each year. So you do that for each year. Then we bring our discounting factor at the rates we're given. So we're given a rate for discounting That was 8%. So we bring the 8% here. We calculate for the discounting factor for each year. So the first year is 2024. So that one use the discounting factor 1 year for that. The second year is 2025. So use the discounting factor 2 years for that. The third year is 2026. So use 3 years for that. So let's calculate for the discounting factor for each year. Each year, what are you going to get? Four decimal place. Let's see it in four decimal place.
Year one is 0.909.
0.909.
Nine. Yes.
On okay.
Yes. Yes. Yes.
Then
Year two 0.8264.
8264.
Six four.
Please, I think the one she's
And then
mentioning is 10% too. We are using 8%.
We are using 8%.
hey, sorry. I'm giving you 10%. Sorry.
Okay, we are using 8%. So what's the answer?
0.9259.
0.9259.
59.
Next.
0.8573.
0.8573. Next one.
0.7938.
0.7938. Okay. And then we multiply for each to get their respective answers. So this becomes the present value for each. Then we sum all of them up to get a value in use itself. So value in use, you need to sum all the three up. So when you sum all the three up, what do you get? So let me do that here. Is this plus this plus this. So this becomes our value in use. Is there a question on this? Okay. So we move on to the second question, question two. Yeah. Isaac, read for us.
Question 2.
Yeah.
Sando Limited is a company which manufactures machinery for industrial use and has a year end of 31st December 2021. The directors of Sando Limited require advice on the following transactions. I. Sando Limited acquired a cash generating unit several years ago, but at 31st December 2021, the directors of Sando Limited were concerned that the value of the cash generating unit had declined because of a reduction in sales due to a new competitors entering the market. At 31st December 2021, the carrying amount of the assets in the cash generating unit before any impairment testing were. So we have property, plant and equipment 20 million, goodwill 6 million, other assets 38 million. II. The fair values of the PPE and the other assets at 31st December 2021 were 20 million Ghana cedis and 34 million Ghana cedis respectively. And their cost to sell were 200,000 Ghana cedis and 600,000 Ghana cedis respectively. The cash generating unit's cash flow forecast for the next 5 years are as follows. I am. The pre-tax discount rate for the cash generating unit is 8% and the post-tax discount rate is 6%. Sando Limited has no plans to expand the capacity of the cash generating unit and believes that a reorganization would bring cost savings, but no plan has been approved. The directors of Sando Limited need advice as to whether the cash generating unit's value is impaired. The following extract from a table of present value factors has been detailed below. Required. With reference to relevant international financial reporting standards, advise the directors of Sando Limited on how the above transactions should be accounted for in its financial statement as at 31st December 2021.
Okay, thank you. So you can see clearly this question relates to cash generating units. And for cash generating units, let's talk about that before we solve. So let's do a revision on cash generating units. So cash generating unit, first thing is first is that you need to calculate for your impairment. So you have to check for the condition for impairment and get your impairment amount. Now once you get impairment amount, you share the impairment. And you're supposed to share using some basis, right? I think today someone was even mentioning that. So how do we share? Well, how do we share? We share on pro rata or no. What's the first thing you share before you do pro rata? What are the things you do before you do pro rata for a cash generating unit? Yeah, Isaac. Yeah, Chrissy, your hand has been up, sir. I don't know whether you wanted to say
Yes, please.
something.
I'm
Okay, then.
I'm answering to the question. Yeah, so you get rid of the worthless assets first.
Okay, so first thing is worthless assets. So worthless assets. Second is what was the second thing?
Goodwill.
Isaac. Okay, I've said it already.
Goodwill. Okay.
Goodwill. And then what was the third thing? Isaac.
Uh, I think after that, the remaining you shared pro rata among the rest of the
Rata.
assets.
So that one is share for other assets in a question on pro rata base. And when we say pro rata, what does it mean? It means you share based on their values. You share based on their values, basically. So in this question, we first have to get our current amount of our cash generating units, which we have over here. Then we need to get a recoverable amount for each. So here we have our current amount here. So question 2, we have a current amount of our assets given to us already as 64 million. We need to get a recoverable amount. And how do we get a recoverable amount here? Recoverable amount here will be our fair value less cost to sell and then the value used. So let's see the fair value less cost to sell, what we're given in the question in this case. So yeah, we're given that the fair values of property, plant, equipment and other assets were given us 20 million and 34 million. And then they gave us their respective cost to sell to be 200,000 and 600,000. So we'll do that for each. So PPE, yeah, we're given a fair value. We pick the fair value less the cost to sell. Fair value was 20 million. Yeah, so 20 million, yeah. Then we less the cost to sell for PPE, which is 200,000. That's 0.2 million. So 0.2 million. And I think, yeah, we'll get 19.8, right? 19.8 million. Then we do that for other assets. So yeah, other assets, we have 34 million. And then we deduct 600,000. So that's 0.6 million. Yeah, we'll get 33.4 million. Then when you're done with sum the two up. So what do we get when we sum the two together? So 19.8 plus
53.20.
53.20
Point two.
million. Okay. So that's our fair value. Let's cost to sell. We need to get a value in use over here. So value in use, remember that one you calculate for your present values. So let's see what we're given. We're given a cash flow estimate for the next 5 years. But here you have been given two estimates: pre-tax cash flow and post-tax cash flow. Which one do we use?
The
Pre-tax.
pre.
We use the pre-tax. That's good. And then the cost of capital too. We have 6% and 8%. Let's see what each represents. You see, we're told that here the pre-discount rate for the cash flow is 8%. So 8% is for the pre-tax, and then the post-tax is 6%. Which one do we use over here? Do we use the 6 or 8?
The 8.
8.
Yes, 8.
Because that one is a pre-tax discount rate. So we have to use a pre-tax one. Remember that your cash flow, as we said, should always be before tax. So, and then the discount rate should also be before tax. So we do that in that respect. We calculate for our present value. To do that, we bring the year cash flow discounting factor at the rate. And here we say the rate is 8%. And then we multiply to get our present value. So we bring the respective years in this case. Let me see the currency sign. Million on top. So the years is for 5 years. We bring their respective cash flows. 16, 14, 10. So 16, 14, 10. And then the last two is 6 and 26. 6 and 26. We bring their respective discounting factors for each year. This is 0.925259, 0.9259. Then next one is 0.8573, 0.8573. Then next one 0.97938, 0.7938. Then next 0.7350, 0.7350. Then 0.6806, 0.6806. We multiply each to get their respective present value. So it's going to be this multiplied by this, and we do that for the rest. So that will be this to this. And this becomes our value in use. So our value in use, we know the value in use here. Let me just write it here. Value in use here is our 56.86 million. Now we compare this with the fair value less cost to sell. Which one is higher? So this is our fair value less cost to sell. 53.2 million. And this is 56.86 million. Which one is higher?
Value use.
Value in
It's
use is
8.
higher. So
Yes.
since that one is higher, that one becomes a recoverable amount. So remember we pick the higher figure, and that is the value in use, which is 56.86 million. We are the next thing, we check the condition for impairment. So what's the condition for impairment? Carrying amount should be greater than recoverable amount. What's our carrying amount? 64. Is it greater than our recoverable amount? 56.86.
Yes, sir.
It's greater. So that means that there is impairment. Before you go ahead to calculate for impairment. Okay. So impairment here will be carrying amount minus the recoverable amount. So our impairment, yeah, carrying amount here will be 64, 64 million. Recoverable amount will be 56.86 million. What do we get?
7.14.
7.14. Yeah. And when we are done, we do the allocation. Do the allocation. That's the next thing we do. So yeah, in doing the allocation, we first have to bring the assets we have. So yeah, these are the assets we have: PPE, goodwill, other assets. Now, how do we do the allocation? We have already done the steps to do the allocation. The steps to do the allocation, we say the first thing is worthless assets. So we'll bring our worthless assets. We check in the question. Do we have worthless assets in this question? Do you have worthless assets in this question?
No, sir.
No, we don't have worthless assets. So what's the next thing we move on to? The next thing is what? Goodwill.
Goodwill.
So yeah, we'll bring our goodwill. What's the carrying amount? We bring the carrying amount. Let me bring the Ghana city here. Bring the carrying amount less the impairment, and then we get a carrying amount after impairment. So goodwill carrying amount is 6 million. We bring that here. So we say we allocate first to goodwill. So we check the impairment we have 7.14. Can it cater for goodwill? The 6 million. Can we deduct 6 million from 7.14? Will it be enough?
Yes, sir.
Yes, sir.
It will be enough. And then some will be less. And so that's that. So we have done goodwill. The next thing is we are supposed to do for other assets, right? We said the sharing. Worthless assets first, second goodwill, and other assets on pro rata. So yeah, we have done goodwill. We are left with our other assets. And yeah, the other assets in our question is any other asset apart from goodwill. So any other asset apart from goodwill is PPE and then other assets that we have here. So these ones we need to share for them on pro rata. So we'll do for PPE. The current amount of PPE is 20. Then other assets, the current amount for it is 38. So yeah, we'll do the sharing on pro rata as we said the last time. So pro rata, we first have to know the remaining impairments. How much do we have left from our impairment figure? That would be the total impairment that we had, which was the 7.14 million, and then we have deducted 6 million for the goodwill. So how much do we have left? We have 1.1
1.14.
million. Yeah. Then we share this for PPE. So how do we share for PPE? We say we do it on pro rata. So we bring the PPE value, which is 20 here, and then you divide by the total asset you're dividing by. And the total asset here is 20 plus 38. These are the two assets we are sharing for. So it's 20 plus 38. That will give us what? 58. Then we multiply by 1.14 million. What do we get?
That is 0.39 million.
9.
39 million. Then we do
Mm.
that for other assets too. That will be the 38 divisible by 58 times 1.14 million. What do you get?
0.75.
0.75. So these will be their respective impairments you have. You bring their values here, 0.39 and then 0.75, 0.75. So we deduct that, and this becomes the carrying amount after impairment. So basically, you are done after this point. But there is always one condition you always have to check. The question always is that whenever you deal with cash generating units, the standard says that whenever you deal with cash generating units, you always have to compare the carrying amount you have gotten after impairment with either the fair value less cost to sell for each asset and or the value you use for each asset. You have to make sure that it is not lesser than that. So we need to check. So value in use, we're not giving for each asset, we're giving for everything combined. Let's check for fair value less cost to sell. Fair value less cost to sell, we're giving for PPE and other assets. So we need to check whether the current amount you have gotten after impairment, whether it's lesser or it's not lesser. If it's lesser, there is a problem. We need to now reverse it. But if it's not lesser, then we are good to go. So PPE value is 19.8 million. Let's check whether what we had was lesser than that. Yeah, we had 19.61. Is it lesser than the fair value? Or it's not?
It is.
Yes, sir.
It is. It is. So yeah, if it is, what are we supposed to do? You are supposed to reverse it back to the fair value less cost. So the standard will tell you that it shouldn't be lesser than any of the highest of your fair value less cost to sell and then value you use for each. Yeah, I'm talking about each asset. I'm not talking about combined. Each asset. So yeah, 19.8 million is the value they give us for only the PPE. We compare it with this and realize that fact it's rather lesser. What do? We need to reverse this one back to the 19. We need to reverse it back to 19.8 million. We need to reverse it back to this figure, 19.8 million. So how are you going to do that? So we need to look at the difference. What's the difference here? 19.61 and 19.1. 8. What's the difference?
0.19.
0.19. So we needed to add back the 0.90. That means that your impairment, your actual impairment for DPE will be 0.39 minus 0.19. We are reducing, are we reducing it or adding? Yeah, we are reducing it.
Using it.
Yes. So we are reducing this 0.39 by this 0.9. So it means that if you are to calculate for your actual impairment, so your actual impairment for PPE, because we are reversing some, yeah, because we are reversing some, it will have been the original figure, which is 39 minus the 0.19. And what are you going to get as the actual?
0.2.
0.2 million. So yeah, our actual carrying amount that we need to get after impairment should be this. So it means that we are supposed to reverse some portion of that. That's what we have done. But yeah, the question is, you are going to reverse it into what? So what else do? You reverse it into what? So you give it to the next asset you have. So yeah, we have other assets. You share it for the remaining assets. That's a rule. That once you realize that it doesn't fall within that, you have to share for the remaining assets. Yeah, so you share the 0.9 for the remaining asset. And yeah, we only have one asset. So we just share it for that one asset. So it means that this 0.919, we have to give it to the other assets. And this will be additional impairment. So bear in mind, this will be an additional impairment. This will be an additional impairment. But the first impairment, this is the first impairment, 0.75. This was the first impairment. So this becomes an additional impairment that we have here. So that the actual in this case will now be this minus this. Oh, someone mute yourself. Oh, Tracy, please mute yourself. So that will be this minus this, which will give us 37.06. So this will be the actual carrying amount of your assets. So you sum this together to get your cash generating unit, the value for your cash generating unit, the total cash generating units. So this will be your total cash generating unit. And this will be your individual carrying amount after impairment. So yeah, the only thing is that you have to remember that last condition I spoke about. That whenever you get a current amount after impairment, check in your question. If they give you the individual, in some questions they'll give you, some questions they don't give you. And the questions where they don't give you, it means they don't want you to compare again to check if it is lesser or not. But in this question, they give us for fair value less cost. So that's why we have to check. Now that we have checked, we can even check the last guidance and be sure whether it is it lesser or it's not lesser. So we can just check just to be sure. You can see the other assets. We have 33.4. You can see that this value we have gotten is way above it. So we are good to go. It's way above it. So we are good to go. So this is how you go about this question. Yeah, I picked this question because it touched on almost everything I wanted to talk about on the impairments. So if there's a question on this,
Sir, please, you said, how do you know that you have to check or not?
yeah, you compare. You compare your current amount after impairment with the individual value, either for your value in use or fair value less cost to sell. In this question, we're not giving individual for value in use, but we're giving individual values for the fair value less cost to sell. So our PPU, we're giving the individual value for it. Our other assets, we're giving the individual value for it. Another fair value less cost to sell. So that's why we have to compare.
Okay, so it won't be stated in the question that compare, but you have to know.
You have to know. You have to know. The question will never tell you. Yeah, you have to know. Is there any other question? Okay, it's 12:21. So we'll end there. We have exceeded by 21 minutes. So we'll end there. We'll continue. I think tomorrow, the timetable says tomorrow we'll be meeting again. So we'll continue the standards and move on to evaluation for tomorrow. Thank you very much for joining. See you in our next meeting. Bye bye.
Thank
Hello,
you.
say,
Bye.
Yeah, Abigail.
please will your